Right, the next rule is to be patient and think long term. Whether you're an investor or trader, you got to be patient, you got to think long term. The reason why most people never succeed at investing is because of the wrong expectations. They think they're going to become a millionaire overnight. They're looking at, getting wealthy overnight. So the moment when they see that their money is not growing as fast as they think it should, they get impatient. They abandon their investment plans, or they get distracted by the next big thing. They say, stocks are too slow, let me trade Forex. Forex too slow, let me go trade options. And they go round and round in circles, or Bitcoin or binary options, and they don't stick to something long enough to really allow it to work in their favor and to grow their wealth in the long run. Buffett famously said, the stock market is a wonderfully efficient mechanism for transferring wealth from the impatient to the patient. That's right. So again, most investors abandon their investment strategy and fail because they grow impatient when they don't get rich overnight, right? So there's no such thing as a get rich quick scheme. It doesn't exist. If someone tells you can get rich overnight, you got to run away because it's a scam, okay? Because successful investing is not about getting rich quick. It's about getting rich slow and sure and steady. Just like, the hare and the tortoise. The hare runs really fast, but doesn't get anywhere. The tortoise is slow and steady, but eventually it reaches the finish line. Remember that it takes time. The power of compounding is amazing. It allows small money to grow into phenomenally huge sums of money. But the power of compounding requires time for small money to compound into huge sums of money. Let me share with you a little metaphor here. Now, some of you have heard of the rule of 72 or the law of 72 that says that how many years does it take to double your money depending on your rate of return. Now, I've proven to you in the earlier part of this course that if you follow the strategies in this program of fundamental and technical analysis, you should be able to get at least 20 to 25% return a year on average. So if you can get a 25% return on average a year on your portfolio, basically you just take 72, because it's called the law of 72, divide it by 25% return a year. That's roughly about 2.88 years. So what does this mean? It means if you can get a 25% return on your portfolio, and I've shown you in the earlier part of this course that it is really possible. I do it, my students do it. In fact, some of my top students are getting 50 to 60% return a year. But let's not talk about my top students. Let's talk about my average students that are getting 20 to 25% a year. If you get 20, 25% a year, you are doubling your money every 2.88 years. Every 3 years, you are doubling your money, you're doubling your money, and you're doubling your money. All right. But again, let me give you a metaphor to show you why people grow impatient. And the metaphor is a game of golf, right? Now, even if you don't play golf, that's fine. But you should know that golf has 18 holes. And let's imagine I have a friendly bet with you. And I say, you know what? We're going to bet on the game of golf. We're going to increase our bet in every hole. Now, for the first hole, we're going to bet 10 cents. Okay? The next hole, we're going to bet 20 cents, and then 40 cents, and 80 cents, and we're going to double it until we reach the 18th hole. Now, without using your calculator, and if you don't know this, just guess. What do you think the bet will be on the 18th hole? Just give it a wild guess. Without calculating, just give it a guess. All right? Have you got a figure in your mind? Just think of a figure. Got it in your mind? Let's see what it is. All right. On hole 7, it's $6.40. Okay? Hole 8 is $12.80. We're doubling it, right? Hole 9 is $25.60. So we are halfway to 18 holes. We're at $25.60. All right. So do you want to change your mind on what the final result will be, or you want to stick to what you think it is? Okay. Sticking to that? Great. Hole 10, $51. Hole 11, $102. Hole 12, $204. 409, 819, $1,638. We have got 3 more holes to go. We're at $1,600, starting from just 10 cents a bet. Hole 16, 3,200. Hole 17, 6,000. And the final hole, a whopping $13,000 bet on the final hole. Most people would not have guessed that. Why? Because we start with just 10 cents. But the point is, with just 10 cents and you double it, what happens? Initially, notice that for the first couple of holes, notice that it grows really slowly, right? It moves really slowly. It's like watching the grass grow, and you're thinking, you know what? There's no way I'm going to be rich. It's growing so slowly, right? But notice what happened. The moment you reach a certain point, it explodes, right? And from 102, it jumps to 6,000 and 13,000, right? In just a couple of holes. So can you imagine if you started investing 1 year late? If you just started 1 year late, instead of getting 13,000, you only get $6,000. If you started 2 years late, you only get 3,000 instead of 13,000. If you started 4 years late, you get only $1,000 versus $13,000. So you can see that you have to start investing as early as possible, because 1 year that you delay, if you project it to the future, it's huge sums of money. All right. If you take a look at how Warren Buffett grew his wealth to become one of the richest men in the world with a net worth of close to $60 billion. That's $60 billion. Now, he started investing at the age of 11 years old. But at 14 years old, he had $5,000 at 14 years old. At 15 years old, he had $6,000, right? And then at 19 years old, he had $10,000. At 21 years old, he had $20,000. So notice again, just like that game of golf, the initial years is really slow. And most people get so bored. They say, oh my God, it's too slow. I give up, right? It's like watching the damn grass grow, right? But see, money doesn't grow in a straight line. Money grows in a compounding fashion, right? So it keeps growing. And then by 30 years old, he was worth $1 million, and 1.4 million, 2.4, 3.4, 7 million, 8 million, 10 million, 25 million, 34 million, 90 million, 67 million, 300 million, 600 million. And it was only in the last in the last 3 years that it grew from 3 billion to 17 billion to 36 billion to 58 to 60 billion dollars, just like that golf game. So you got to be patient for those initial years that it grows slowly. Be patient, stick there, stick to it, and you'll be extremely wealthy in your life. Okay, let's go for the next one. So the next rule is to think independently. Again, the reason why most people don't succeed in investing is because most people have this belief that there's safety in numbers. As human beings, we are wired to follow people, right? We think that, if everyone is doing that, it's got to be safe. But the trouble with investing is that opposite is true. If you do what everyone else does, you're going to lose money. Because in the world of investing, it is the minority that makes money, the majority that loses money. So in order to make money in the financial markets, you have to think independently and totally opposite of what most people are thinking and doing. Now, what do most people do? Most people buy when they are excited. And when are they excited? They're excited when everyone around them seems to be making money. When it's, everyone's making money, the market's doing well, the economy's doing well, that's when they buy. And that is the worst possible time to buy, because when you buy at that point, you're always buying at the top, all right? And when do most people sell? Most people sell when they see that everyone's losing money, right? When the market's crashing, economy is doing bad, and that's when they sell. And that's the worst possible time to sell, right? So let's take a closer look at this, right? The majority of investors lose money in the markets because to profit, you have to think differently from the masses. You have to be fearful when others are greedy. So in other words, be fearful when everyone is greedy and the market's too high. That's when you don't want to buy. When everyone is buying and the market is overvalued, you don't want to buy. In fact, that's when you want to sell. And you got to be greedy when others are fearful. In other words, when no one dares to buy the stock market, when prices are down, it's undervalued, that's when you buy. It's taking a contrarian approach to the markets. Don't be like lemmings. Lemmings are kind of like these critters that kind of like follow each other around blindly, right? So when one lemming jumps off the cliff, the rest of the lemmings follow and they all die together because they blindly follow each other. Okay, rule number 6, risk management and capital protection. I can't emphasize this enough. Let me tell you the difference between an amateur and a professional investor or trader. Amateurs, before they go into a stock or they buy a stock, what's the first thing they think about? That's right, they think about how much money am I going to make, and they're excited going in. Professionals, when we buy a stock, we never think how much we're going to make initially. We always think, how much am I prepared to lose if I'm wrong about this investment or this trade? So as traders, if you're a short-term trader, you always want to place a stop loss to protect yourself, to predetermine a loss to cut if you're wrong. Now, as an investor, we do not place a stop loss, okay? But what we do is we diversify a portfolio. We do not put all our eggs in one basket. With the capital we have, we always diversify into at least 8 or 10 companies minimum to diversify our risk to a maximum of maybe 30 or 40 companies. And we never buy in at one shot. We always enter the market in stages by using what we call dollar cost averaging to average our price in, but at the same time while it's on a steady uptrend or at support levels in a consolidation. Okay? And we always want to risk a small percentage of our capital on any single investment. Okay? So you can always diversify your risk for a very simple reason. No matter how much research you do, no matter how smart you are, you can't get it right all the time. There's no such thing as a sure win in the financial markets. And if you don't diversify your risk, all it takes is one bad investment to wipe you out completely. Okay? So you want to make sure that when those bad investments come, and they will come, they only affect you slightly. So again, when we lose little. When we make a lot more than we lose. That's the whole idea behind it. Next, take responsibility and learn from mistakes. Most people, when they lose money in the markets, what do? They play the victim, right? They say, I'm the victim here, right? It was those bastard bankers that crashed the market. They blame the bankers, they blame the stockbrokers, they blame the government, they blame their bad luck, they blame God, they blame the whole world except themselves. Now, when you blame someone, right? You blame something. You say, I blame, it's my broker's fault, it's the banker's fault, it's the stock market's fault. When you blame someone, you blame something, that means who's controlling your life? Not you, they are. And if they are controlling your life, you can't change your life, right? So the moment you blame someone or something, you're giving your power to them. You've got no more power. So stop blaming, stop giving excuses, stop living like a victim, okay? Always take responsibility and learn from your mistakes. Only when you learn from your mistakes can you have the power to change your results and become a better investor over time. Finally, rule number 8. Never ever attempt to predict where the stock market will go. Whether you're an investor or a short-term trader, as professionals, we never predict where the market will go. As an investor, we focus only on buying fundamentally good companies because we know over time they will increase in value. And we enter when the trend is in our favor, when they're on uptrends, when they're in consolidations at support levels. As traders, again, we enter based on the trend. We don't predict the future, we follow the most probable direction of the price. Now, why don't we predict the future? For a very simple reason. No one can predict the future of the stock market because stock prices are driven by demand and supply, which is driven by emotions, collective psychology of fear and greed in the market. Now, let me ask you a question. Can you predict the collective emotions of millions of people in the market in the future? No, you can't. I can't even predict my wife's emotions the next day. Right? If I can't even predict my wife's emotions, one person, how can I predict the emotions of millions of people? It's impossible, right? So no one can predict the market. So never outsmart the market. The only thing you do is follow the market. If the trend is up, stay in the market. If the trend is down, you may want to get out. Focus on investing in good businesses. So again, the market cannot be predicted. And any attempt to predict the market will always lead to bad performance, because when you attempt to predict the market and you have got a predictive bias, it will cause you to not follow your investment rules, to not follow your trading rules. And I'm going to give you a lot of examples right now on why that happens. Again, your decisions to buy and sell should only be based on fundamental criteria valuation, and reading trends in the market. Never ever have a predictive mindset. It will cause us to not follow our predetermined rules. So to explain, let me show you a couple of examples right now. So let's take a look at some lessons from history. On the 6th of October 2009, there was an article on CNBC that said experts position themselves for Dow 10,000. So basically on that day, the Dow Jones was about 9,800 points. So what it was saying is that, hey, we are bullish. We think that the Dow Jones is going to go to 10,000 points, right? So again, this one was on the 6th of October 2009. They made that prediction. Now here's something interesting. One day prior, on the 5th of October, there was another prediction by another group of fund managers that said that, hey, no, the Dow Jones will fall to 6,300 by year end by these portfolio managers. So again, when you read the news on CNBC, on the New York Times, you read all these news, you've got all these gurus making predictions, right? So one group will say, hey, the Dow will go to 10,000 points. The other will say the Dow's going to go to 6,300 points. So who do you listen to? The answer is no one. Don't listen to anyone, because no one can predict the future. All you do is to follow your investment plan that says stick to good companies. Uptrend, buy. Downtrend, sell, right? So what happened? Where did the market actually go from where it was? So again, let's look at the date. 5th of October, 6th of October. Here we go. Let's look at the chart. So on the 6th of October, you can see that the Dow Jones was over here. So again, one group predicted you'll go to 10,000, the other group predicted you go to 6,000 again. So based on what you've learned in this course, what would you do? Would you buy? Would you sell? And the answer is, look at the trend. Is the trend up or down? The answer is the trend is up. And if you can't see clearly, simply put in the moving averages, which you've learned in this program, right? So as long as the 50 moving average is above the 150 moving average, there's a confirmed uptrend. What do? That's right, we don't predict the future, we just follow the trend. If the river is flowing north, we swim north, right? So what do we do here? We buy. And sure enough, indeed, the market went to 10,000 points, 11,000 points, and as of today, it's at 26,000 points. So can you imagine if you had listened to that second group of people who made a prediction that it was going to go to 6,000? What would have happened? You would have missed that great opportunity of making money in the stock market. Or worse, if you had short sold the market, you have lost a lot of money and got crushed as the market went up. So the point again is this: never ever listen to people's predictions, because no one can predict the market. You know what? Even among the billionaires, they can't agree where the market is going. On the 22nd of September 2011, George Soros, he said the US is already in a double dip recession. So we went through a recession in 2008 and 2009. We're going through another recession. So he was bearish. He went short on the market. He shorted the market. You know what? 1 week later, on the 30th of September 2011, Warren Buffett said, hey, you know what? I'm buying stocks. They are bargains. The US recession is very, very unlikely. So again, who the heck do you listen to? One guy says we're in a double dip recession. The other guy says recession is very unlikely. And the answer is don't listen to anyone, because no one knows where the market is going. No one can predict the future. And predicting the future, again, is futile. All right, here's a good one. Before the 2016 elections, right, everyone predicted that Hillary Clinton would win and Donald Trump would lose. All the polls said so. And I believe that myself, right? And here's the interesting thing. People said if Trump were to win, the US stock market will crash. That's what everyone said, right? It says here, right, if Trump wins, expect a swift sell-off in US stocks. And this guy, Mark Cuban, who's a billionaire, said that stocks could crash 20% if Trump becomes president. So what did many people do the moment Trump won the election? That's right, many people tried to outsmart the market, and the moment the news was announced, they short sold the market. And guess what happened? This is what happened. The moment Trump won the election, in November, the stock market did not go down. In fact, the stock market went up. by 12% all the way to 2,400 points, and now we're almost at 3,000 points. And those people who attempted to outsmart the market and predict the market lost a lot of money. And sadly, one of those people was George Soros, who lost nearly $1 billion by shorting the markets. So you can see that even among the billionaires, they attempt to predict the market and they get crushed by the market. So never predict the market. What you should have done is to see that, hey, the market's on an uptrend, the 50 is above the 150, stay in the market and ride the trend up. Okay, I hope you really understand what I'm talking about here, right? Never predict the market, follow the market. Here are some more cases in history. This guy, his name is Alan Greenspan. He was a Federal Reserve chairman back in the 1990s, right? And what happened was in 1996, the S&P 500 went from 500 points to 750 points. A big run in the stock market. And what he said was that investors are undergoing a bout of irrational exuberance. So what he's saying is that, hey, it is irrational. The stock market has gone too high. It can't go high. It's going to crash. So that's what he said. And again, what happened after he said it? Well, this is what happened. From 750 points, the market went on to 1,500 points. Okay, so even the Federal Reserve chairman can't predict where the heck the market is going. And if you had listened to him and had sold, you would have missed another 100% return in the market. And that's why, as successful investors and traders, we never ever listen to the opinions of other people. We always stick to our game plan and follow the trend and stick with good companies. Here's another example. This was during the financial crisis, and the S&P 500 dropped from 1,400 points, boom, to 1,300 points. So people were wondering, hey, is it going to get worse or have we hit the bottom? And at that time, the Federal Reserve Chairman, Ben Bernanke, he said, I quote, "The subprime mortgage crisis is largely contained." In other words, no worries, guys. We are taking care of it. The market's okay. So people who listened to him, right, would have held on to their stocks at this level when you should have sold. Why? Because you can see the trend from an uptrend has now reversed into a downtrend. So on a downtrend, you never want to hold stocks. On a downtrend, low gets lower. And sure enough, from 1,375 points, what happened? The market further went down, boom, all the way back to 700 points. And again, by listening to these experts, you would have gotten crushed in the market. Right? So don't listen to anyone, just listen to yourself. Do you understand? Right? Let me share with you my final slide. Okay, here's my final slide. Now, I want you to take a look at the stock market, the S&P 500 for the last 9 years. From 2009 to where we are today, 2018. And you can see the stock market has gone from about 1,000 points to 2,900 points. Can you see that? So far for the last 9 years, the stock market has increased by 329%. And that is roughly 16% a year compounded. Okay? So in other words, a monkey could have made money in the markets. A blind, one-legged squirrel monkey could have made money in the markets. Any idiot could have made money in the markets. I made so much money in the last 9 years, and so did many of my students. And no matter what you do, in fact, if you had just bought and closed your eyes through the ups and downs or did dollar cost averaging, you have made 300% return. If you had done trend following, which is what I teach as well, follow the trend, right? So over here, you can see this is an uptrend. So you buy there, you would sell there and make a small profit. This is an uptrend signal. You buy there and sell there. When it crossed, make a profit. And you would have bought there, catching the new uptrend, all the way selling at a crossover here. Now, you wouldn't buy here because the 150 is still sloping down. You'd have bought somewhere here. When the 50 crossed the 150, both moving averages are sloping up, you have made money there. In other words, if you had followed the trend, you would have bought here, sold here, bought here, sold there, bought there, and sold there, right? So you can see that whatever method you would have used that I teach in my program, you would have made money. But you know what's the sad thing? There were people who came to my course. They learned all my strategies, buy and hold, follow trend. But some people did not make any money in the last 9 years. And do you want to know why? Because they went to read news and again listen to the opinions and predictions of all these gurus. And when they listened to all these predictions, they did not stick to their investment plan and they missed out on a 300% return in the markets. Let me show you all the news articles that came out in the last 9 years. And if you would have read these articles, there's no way you would have stayed in the stock market and you would have missed out on these gains. Let's look at what these articles were. The first article was on July 2010. And what does it say? This was the New York Times. It says, a market forecast that says take cover. With the stock market lurching again, plenty of investors are nervous. Ooh, and some are downright bearish. And then there's Robert Preacher, this guy, the market forecaster and social theorist who is in another league entirely. Mr. Preacher is convinced that we have entered a market decline of staggering proportions, perhaps the biggest of the last 300 years. Holy crap! Imagine if you had read this article on July 2010, would you have dared to stay in the stock market? No, you say no way, it's gonna crash, biggest crash in 300 years, and this guy looks smart. And if you had listened to this guy, guess what? You would have missed the run from 2010 all the way. You have missed a 300% return because of listening to these experts. Next one, money news. Controversial interview exposes that 5 signs stocks will collapse in 2013. Stocks didn't collapse in 2013. In fact, in 2013, the stock market went up by double-digit returns. Next one, June 5th, 2013. Another guy says, Doomsday Poll, 87% risk of stock crash by year end. Never crashed. USA Today, this was April 2011. S&P lowers its outlook. Question, could US default on its debt? At that time, people were talking about the US debt ceiling, right? That the US government's going to shut down, oh my God, and the market's going to collapse and no one dared to buy stocks. And again, they missed that great run in 2011. Next one was Bloomberg News. This was back in 2013 again. A US default seen as catastrophe, dwarfing Lehman's fall. So Lehman Brothers collapse in 2008 was bad. This is going to get worse. And again, if you had read this, you would have stayed out of the markets and not stuck to your investment plan. Next, November 2012. Europe debt default are poised to rattle stocks. Oh my God. So now the US has a debt crisis and now Europe has a debt crisis. Who dares to buy stocks? Last article. This was 2 years ago, January 2016. Analysis, here comes the biggest stock market crash in a generation. So stop reading this crap. If you keep reading this crap, you'd have missed the gain all the way. Okay? Now, eventually, they're going to be right. Eventually, of course, the market's going to crash. What goes up has to come down. I'm not saying it's not going to come down. It will come down. But don't predict the market. Follow the market. So what you've learned in this course is follow the trend. The moment you see stocks get overvalued, the moment the market reverses into a downtrend, you gotta get out. So don't worry, as my student, I'll constantly update you when to get out of the markets. Not by listening to all these people, but by following the trend and looking at market valuations. I hope you enjoyed this lesson. It's lesson 10. I'll see you guys in lesson 11. Take care.